Hello, my name is Semyon Fedorov, and today I'd like to present one of our studies on risk and benefit sharing schemes in oil exploration and production, which is a part of my PhD project, Cost-Effective Development of Small Discoveries on the Norwegian continental shelf. As you can see, the share of small and medium-sized companies acting on the Norwegian continental shelf over the last years has increased. And with our study, we're trying to address several challenges that smaller oil companies often experience right now. The first one is high risk exposure to the market and technical uncertainties due to the fact that smaller companies have smaller portfolios where they can't distribute risks between them. Second one is lack of knowledge in advanced operations such as drilling. And third one is higher cost of capital and overall more limited access to financial markets to raise capital. It means that smaller oil companies are willing to involve third parties into the oil field development process in order to share risks and benefits. And this challenge we address in our study. So in our study, we analyze a field development case where oil company invests in a small discovery under prominent reservoir uncertainty accompanied by the oil price risk. So the field operator has two contract strategies to choose between. The first one is standard hiring agreement, where oil company hires a drilling company to perform this operation, and it fully covers the drilling costs. And the second one, the strategy that we propose and analyze is risk and benefit sharing, where oil company and the drilling contractor engage in a long-term agreement in order to share drilling costs and future revenues from the oil production. So in return for the fact that the drilling contractor covers some portion of the drilling costs, the field operator will have to pay a certain percent in profit after petroleum tax to the drilling contractor while the oil production starts. So our goal is to ensure a fair distribution of risks and benefits between the field operator and the drilling contractor and evaluate the economic potential of such a scheme. And in order to do so, we incorporate a flexibility in a contract called exit clause. And this exit clause provides parties with a flexibility to optimize their decisions over time. So both parties can withdraw from the partnership within a stipulated period of time of the oil production start. And this decision can be triggered by the state of the oil price and the production level that the field delivers. So both parties can observe the oil market and the production rate in order to decide whether they want to remain in partnership until the next time step or they want to exit, which means that the drilling contractor would receive the compensation for that. Therefore, the exit clause reduces the need to renegotiate the contract if something changes, like the oil price and production level fluctuate unpredictably. So we apply the real options approach in order to optimize the contract policy over time based on the simulated oil price and the production rate. So we identify a combination of the oil price and the production rate that trigger either of the parties to withdraw from the partnership, but there is a region in between where the parties want to remain in partnership. So intuitively, the oil company wants to exit when the oil price is high and the field production is high, because it becomes too costly to pay for the participation of the drilling contractor in such a scheme. So the exit clause provides flexibility for both parties. So optimizing the contract policy for both parties over time, we can see that in 50% of the cases, the partnership holds until the end of the lifetime of the field. And for example, in 21% of the cases, either of the parties initiates the withdrawal in the first year after the production start. But we can see that there is also value of waiting for the exit. After optimizing the contract policy for both parties, we can find the project value from both the perspective of the field operator and the drilling contractor. And we can see that we provide only the lower boundary for the drilling contractor to be interested in the risk and benefit sharing scheme. So under these conditions, he's indifferent between the two strategies. And in that case, the whole value surplus goes to the side of the field operator. And if the drilling contractor is willing to be compensated more for taking additional risk within the risk and benefit sharing, the field operator will have to share more profits after tax in order to attract the drilling contractor. But apart from the drilling contractor and the field operator, we make sure that the regulator is interested in establishing the risk and benefit sharing in oil exploration and production. And we make sure that the tax received by the regulator is at least at the same level as in standard hiring agreements. And actually our results show that risk and benefit sharing might increase the tax revenues for the regulator. So we can say that the risk and benefit sharing can become a competitive form of contracting on the Norwegian continental shelf, attracting both the contractors and the field operators and license partners, but it is also beneficial for the regulator. You will be able to find further details in academic article that we expect to be published soon.